interaction with the management at Varroc, surely the deal of last week. Now let's go across to the management at MAS Financial Services. Mr. Kamlesh Gandhi, CMD, is with us. Sir, thank you so much for taking out time for us. First, of course, is the numbers. But I think that, a lot has changed after what RBI did yesterday. So can you just talk to us about the liability side of the business? How are you prepared? Everybody knew rates will go up, but will they go up so fast, so soon? How has it changed the company's analysis of liability side?
Thank you. So on the liability side, if I share with you, majority of our borrowing is MCLR based and it is not EBR based. So we are not worried about a sudden rise in the interest rates as far as our lending profile is concerned. And while the track record which we have maintained over more than 2 decades, even though there is rise in MCLR, we'll be in a better position to negotiate with the lenders to pass on the minimum of the interest rates hike to us. Having said that, this is inevitable that once the interest rate increases, our borrowing cost will also increase. But we being into NBFC, we don't consume money for ourselves. We do it for our own lending. So the same will have to be passed on to the borrowers.
Gandhi, but shifting focus back to your own business. Now, you had earlier guided that you're looking at achieving an asset under management book of over 10,000 crore over the next 3.5 years. How are you moving forward on that target? Are you on track with the 20-25% CAGR growth that you had anticipated?
Absolutely. Evident from the results this year, where we have registered a close to 17% growth in AUM and a corresponding growth in profitability. We say that we are well on track to our original pre-COVID growth rate trajectory of anywhere between 20 to 25%. And that should take us past 10,000 crores within the next 2 to 3 years.
Right. So, can you just talk to us about, rate hike cycle, once it will get over? What does it essentially mean? Once rate stabilizes, planning can be done accordingly and loans will be given accordingly?
See, this is a very continuous process because as and when the rate increases, there will be a lagged effect of that impact on our borrowing, and so will be the lagged impact on our lending rates also. So this will be a continuous process depending upon how the dynamics works out. We will be working with our borrowers and lenders closely so as to minimize the impact on the NIMs and hence the ROAs. So if the rate stabilizes, the further lending rates will stabilize, as we saw in the last 2-3 years when the rates were almost at a stable levels. We were in a position to extend loans to our borrowers at a very stable rates. Nonetheless, we were passing through an unprecedented time of COVID. But if we focus on the lending and the borrowing rates, once it stabilizes, that's a chain reaction. That once the borrowing rate stabilizes, the lending rates will also stabilize.
Right. Mr. Gandhi, everybody is comparing this situation either to what happened with 2011 and how essentially there was a sudden slowdown in the bond markets, or, what happened in 2018. And once again, you saw, really no demand coming in for various bonds. You think this time around growth is pretty strong, the underlying growth, all the markets are running quite efficiently, and rates may be slightly higher or plus or minus 10, 15, 20 basis point, but there'll be no dearth of funds?
See, if we listen to the RBI governor's message yesterday, the message was very clear that the markets will not suffer because of lack of liquidity. So there will be sufficient liquidity in the market, and as we know that demand side is pretty strong post this COVID, and we see that this rate will be absorbed and will be absorbed successfully over a period of time. Nonetheless, it will be tough for the borrowers, and that too for the small borrowers to pay more interest rates. But at the same time, this is the price you pay for a stable economy. So I think overall, I don't see much impact on the growth going forward. And no two situations are comparable. This is completely a different situation, what we saw in 2011 or 2018.
So just a word on, when you see such sharp rate hikes, as of the last couple of years, we've seen, no major NPA issues across corporate retail side. You think with such sharp hikes, does that change anything? Or do you think the underlying growth is the main thing and which continues to be strong, and that's why NPAs in the system may not come back?
See, NPAs are not only the function of the rate hikes, it's a function of so many other things, and it differs from company to company and lender to lender. If I talk about our company over all these 25 years, we have navigated through such rate hikes, rate hikes a number of times, and we have not allowed that to have an impact on the credit quality. So that all depends upon what type of credit you extend during normal times. And I see no reason why this time also we will be in a position to navigate successfully. Can't talk about all the lenders, but majority of them, I have reasons to believe that have prudent lending practices, and hence there won't be much hike in the NPAs, or there might not be any impact on the NPAs. And just to share with you, when the rate hikes are done in line of to control inflation, there is an overall increase in the income levels of the borrowers whom we serve. So their propensity to pay more amount of installment is there. So they can pay more amount in terms of their EMIs payout. And that will not ultimately result into echoing of the same into higher NPAs or non-repayment.
Okay, Mr. Gandhi, on that optimistic note, we'll let you go. Would have loved to chat more about your earnings, but running short on time today. We'll do one thing. We'll quickly slip into a very short break. Don't go anywhere. Lots lined up on the other side.